Hello friends, this is Raj Sastry from Raj Option Trading. Today is May 8th, 2022. Hope you're all doing well. In today's segment, we'll take a look at Chinese stocks, the good, the mediocre, and the bad. So we got one company here. It's into gaming, Netiz. This is doing pretty well. So with that, let's look at more companies and see what's worth investing. So let's jump in. Look, from a market perspective, market is very volatile. That's why we got to go after solid companies with great fundamentals. All these major averages, as you can see here, they're not doing well of late. Look, market is tumbling down. This is when you buy quality stocks at a bargain price and hold on to it for a long time. All the major stock indices, the Dow Jones, S&P 500, as well as Russell, all down, as you can see here. So with that, let's jump in here and take a look at Chinese stocks. From a news perspective, look, we got here SEC. They're adding over 80 Chinese companies to the delisting list here. So we got to be careful. A lot of these Chinese companies are in the delisting list here, so we got to be careful. And look, even the bigger companies like JD.com, Pinduoduo, they're added to the list here. And we got a lot of companies. Look here, we got largest companies here: China Petroleum and Chemical Corp, Jinko Solar, Netiz, Neo, and so on and so forth. And then we got here more companies added to the list here. So there are a lot of good companies in the list also. And Chinese authorities are preparing to give US regulators full access to the auditing reports. That's the good news here. Let's see how it will pan out. So my strategy is to really go after better players, fundamentally good companies doing well. So that way we have a chance to invest in these stocks and a great opportunity to bounce back, because these stocks are completely sold off here. So with that, let's jump in. All right, look, this is the good list. As you can see here, these are the good Chinese stocks. And you might ask, what's a good Chinese stock? Because there is a bad rap around Chinese stock. Look, these companies have got positive gross margin, positive sales growth, positive net margin, and overall score more than 50. And look, top of the list, we got YUMC, $40 stock here. And look, we got here nice sales growth here. Sales is 9% growth year over year, and net margin is positive, 10% net margin. And as you keep watching here, they got nice $3 billion of cash, free cash flow positive. And look, they do have some debt, but they're paying around 0.8% interest rate for the debt, which is very, very low. Overall score is 87. That's great here. And look, for the next year, both EPS as well as the revenue growth is double-digit positive here. So analysts are really thinking this stock will go higher because it has got nice EPS growth as well as next year revenue growth. That's why outlook is good for this stock, even though stock is beaten down in the near term. Look, all the way to 1 day up to 2 year it's negative, but in 5 year it has got 24% positive, which is good. So with that, RSI 43 indicates stock is sold off here. You could slowly start buying this stock here. Look, earnings perspective, it's a positive EPS. That tells you companies are really earning money. And from a price to sales ratio perspective, valuation is very low. Even PE ratio is also low, as you can see here. So with that, this is a good one here. And then we got a few more here. We got TME, Tencent. Tencent has got a little bit lower revenue growth here, just 2%. At least it's positive. That's good. And net margin is also positive, up 10%, as you can see here. And RSI is very low. Stock is sold off, as you see here. And look, float is a little bit high. They got some outstanding stock worth, with the $788 million, which is slightly high, but not a big deal here. Stock has been down for a long time, as you can see here, all the way to 2 year here. And look, this company has got nice analyst expectation for next year. Both EPS growth as well as revenue growth is positive. Overall score is 62, which is not bad. It's above 50. It's above average. And look, this stock is this company is buying back their own stock. That's why buyback yield is positive. These are not stock dilution type company. They are buying back their own stock, and they're paying around 2% interest rate. Not too bad. And solvency ratio is solid here. Company is solvent. No need to worry about any bankruptcy situation here. All right, it's also free cash flow positive, as you can see here. And we got a few more names here. We got Wipshop. Wipshop is about $4 billion company, as you can see here. Same story here, positive sales growth and positive net margin, as you can see here. And companies earning money, EPS positive. And look, PE ratio 7.3 indicates very low valuation. Stock is sold off, as you can see here, all the way to 5 year. It's completely sold off here. But next year, EPS growth as well as revenue growth is positive here. Overall score is pretty good. Overall score takes into consideration the net margin, the financial strength, the valuation, and various other factors. That's why the higher the overall score, the better. And look, this company doesn't pay too much interest rate, just 0.80 interest rate on its $486 million of debt here. And this company is also buying back their own share. They're not diluting their share count. And solvency ratio is very good here. Company is solvent. This company is not going to go out of business here. And we got a few more, as you can see here. We got Dakio. Dakio is one of my favorite companies. It's into solar. If China goes into solar, they can really help with their energy situation here. Stock is 42, as you can see here. Nice sales growth. Look at the sales growth here, 254%. Net margin is also positive, 45%. Its top line is growing nicely, and they're maintaining their bottom line pretty nicely here. RSI 48 tells you company is pretty solid here, oversold somewhat, but stock is going higher off late, which tells you it's a good one. It's a bouncing back as the broader market is sold off here. Look at the performance here. 2 year, 5 year, great performance here. Even in the near term, stock is trying to go higher. And look, when they announced the earnings, looks like they gave a little bit negative outlook here. That's why, look, EPS growth as well as the revenue growth for next year is a negative, double-digit negative. Look at the overall score, great overall score, 99. Highest in this list here. And look, the company is really paying a little bit high debt, but a high interest rate, but they don't have too much debt. Debt is very low, it's almost negligible, so no need to worry. And look, company is very solvent here. Nice solvency ratio that tells the company has enough money. It's not going to go bankrupt. And we got a few more here. We got Qfin, which is one of the better names here. Look, it's got nice sales growth here. Qfin has got about 19% sales growth, as you can see here. Net margin is 41%. That's great here. RSI 40 tells the stock is sold off here. And look, stock is down off late. Look, all the way to 1 year it's down, but 2 year it's done good, 59%. And as you see here, overall score is pretty good here, 64. And company is not paying too much interest rate on their loan here, 0.80% on their 872 on their $64 million debt here, which is not bad. All these companies got positive free cash flow. No need to worry. Companies are making money. And we got a few more. We'll not talk about all those things, but look, we got a few more here. I like even Finolution as well as NIO. NIO is a little scooter company back in China. Look, they're doing great here. It's a solvent company, as you can see here. Top line is growing. Look, sales growth is nice, 34%, and also net margin positive. So this is the good list here. So if you want to buy some Chinese name, take a look at this list here and go after these companies. Even though there is some short-term pain, in the long term you could do very well. If you're a conservative investor, you can go after companies with a little more market cap here. As an example, NIO has got low market cap. This is for daredevils, but other companies, look, they got pretty decent market cap, more than $1 billion. All right, now let's jump in here and look at the mediocre list. So this is the mediocre list mainly because, look, the average solvency ratio is less than 12%. I like the average solvency ratio to be about 12%. And there's a negative sales growth in some stocks here, also in negative FCF in free cash flow in some of the names here. That's why it's a mediocre list. Look, we got top of the list LFC here, China Life. That's the insurance company. Look, a company has got a lot of debt. Look, $8.4 billion of debt. On that debt, they're paying 10% interest rate. That's a high interest rate. Company is not going to go out of business because they got nice solvency ratio here. I'm worried about the debt and also the interest rate they're paying on the debt. Stock has not done much. Look, it's been down for a long time here, all the way to 5 year. If you're an investor, you've not made money with this stock here. In the near term, it's trying to turn around, as you can see here. In 1 day, 5 days, slightly going higher. There may be some chance that this can go higher, but I don't like because they're paying so much interest rate here. 10% is too high. And then you got a few more here. You got PIN DIA. Again, this used to be Wall Street darling a while ago. Even though there is a nice sales growth, as you can see here, and net margin. Look, company is not done well all the way 1 day to 2 year here. And look, they got solvency ratio 9%. I like this to be more than 12%. That's why this is also in the mediocre list here. And we got to be a little bit careful in such names here. Overall score is 46. I want this to be a little bit higher, above 50. And then you got Vivo. Many of you know Vivo stock here, $20 stock here. Vivo also has got a little bit less solvency ratio here. Otherwise, stock is doing pretty okay here. But look, it's been in the red for a long time, as you can see here. And also this has got a little bit good expectation for next year. So if you are a patient investor, you could go after such names here, especially given there is a nice sales growth, 24%, as well as nice net margin. The reason it got into the mediocre list is because the solvency ratio is a little bit low. I like the ones which is higher than 12%. It's a borderline, but if you want to buy, that's okay too. And we got a few more here. So look, few names like China Data as example, just a $6 stock. In the 3 month stock has gone higher, but look, free cash flow is negative. That's why it's in the mediocre list here. Even though it's got a nice net margin here and also nice nice sales growth in 1 year. Top line is good here, but look, it's not making money yet. Free cash flow negative right now. And this one has got high short ratio here, so this can go higher. That's what's going on here. In 3 months it went higher. RSI is 55, tells you it had a short squeeze recently. And we got a few more here. Keep a watch on the free cash flow. Many of these companies got free cash flow negative, as you can see here. And we got few companies with the solvency ratio low here. Look, we got one right here, BEK. Otherwise, it's a good stock. I like BEK here. Look, it's got a little bit lower solvency ratio here, and overall score is also overall low here, just 11. And we got a few more, as you can see here. Keep a watch on a few more here. We got Netiz. Netiz is a good company. I like Netiz. Let's pull this up a little bit. Netiz is a good company. I like Netiz, but what's going on with Netiz is let's look at Netiz right here. All right, so Netiz is a good company, but Netiz right now, as you see here, it's got a nice solvency ratio here. And Netiz, let's take a look at this. All right, Netiz right here. So it's performance has been not great of late. Look, performance is a little bit low. It's been negative for a while here, and nice 2 year performance here, 32%, not too bad here. And as you see here, Netiz has got nice sales growth here. Sales growth is look about 14%, not bad here. And also gross margin is 34. This is one of the better companies, and this one has got overall score. Look, overall score is 32, which is a little bit low for me, but I like this company. It's a in the bad list, it's a good one. In the mediocre list, it's a good one here. And we've got a few more here. We've got Nova and so on and so forth. Keep a watch on the free cash flow here, and also keep a watch on solvency ratio, and keep a watch on stocks with a lot of debt and also high cost of debt here. Look, LFC has got high cost of debt here. All right, now look, Alibaba. A lot of people love Alibaba. Look, Alibaba, what's going on is solvency ratio a little bit less here. I like more than 12%. This is just the borderline at this time. They got a lot of debt. Look, $21 billion of debt here, and they're not paying too much interest rate. But what's going on is, their margin is eroding. That's Wall Street does not like it, and also their revenue growth is not happening at the faster clip. That's why Alibaba is in this mediocre list. All right, now let's look at the bad list here. So in the bad list, we are looking at companies with a low solvency ratio, less than 2, negative net margin. Look, net margin for all these companies is negative, and the solvency ratio for all these companies is less than 1, lower the bad. So with that, that's why all these companies are in the in the negative or the bad list here. So if you're trading these stocks, be a little more careful, and take some precautions. These companies can really, some of these can go insolvent, and the ones with a little bit higher overall solvency ratio, like JD, could be okay here, but keep a watch on negative solvency ratios. Look, few companies have got too much negative solvency ratio, like XPAV here. Look, negative 19% solvency ratio here. That's why you got to be careful with such names. Look, we got some more here. YMM, GDS. Look at the solvency ratio here. YMM has got high solvency ratio, and even DIDI has got a high negative solvency ratio, which is not good. So we got few more, as you see here. ZLAB. I know many people like ZLAB here, but look, solvency perspective, they may not make it. So that's why you got to be careful here. So this is a bad list here. So with that, what we'll do is we'll look at one or two companies in a little more detail. All right, so we got more bad list here. So look, all these companies have got a negative net margin. That tells you companies are not making money. Earnings per share is also negative, as you can see here, and solvency ratio is really not great. That's why these are also in the bad list here. All right, now let's jump in here, look at a few companies in a little more detail. First one is Alibaba. Many folks know Alibaba pretty well. It's an e-commerce company, and they also have cloud computing like Amazon, AWS, as many of you know. It's a good company. Look, from an earning perspective, they did great while ago. Look, nice clip here, but right now earnings is plateauing. It's down slightly. From a sales perspective, top line growing nicely. That's a good one here. Shares outstanding is pretty stable here, not too bad. I'm not too much worried. They're not diluting too much. They're also paying down their debt. Look, debt to equity is coming down here. That's also good here. On the negative side here, look, operating margin is coming down. So this is a concern for me. And look, net margin is also coming down. That's also a concern here. Even though company is making money, they're not able to maintain their margin. That's not a good story here. And look, Alibaba falls. As revenue growth worries the Wall Street. Wall Street love to see the revenue growth here. This company is missing the revenue growth in the last couple of quarters. And look, Alibaba stock has been sliding. It look a nice free fall, as you can see here. And on the balance, volume is also coming down slightly here. That tells you folks are not buying Alibaba at these levels here. That's why it's in the mediocre list here, even though solid top line. But look, they're not making it from a margin perspective. Even though it's a positive margin is eroding, which is not good. All right, now let's look at Alibaba and see how is their earnings on a quarter-over-quarter basis. Look, Alibaba last 3 quarters, they've been showing the negative revenue growth here. Look, they've been missing on the revenue growth estimates, which is not good here. And look, in the September last year, they also missed on the earnings per share, which is also not great here. So look, what's happening is off late with all the regulations and whatnot, companies are taking some pressure, and they're missing on the revenue, and also their margin is eroding. That's what's going on here. Even though historically it's a great company, look, they've grown nicely in the past, but look what's going on off late here. Off late, the revenue growth is coming down here, plateauing, as you can see here. All right, that's why it's in the mediocre list here. Be careful. It's a good company, but I like to see positive margins or margins improving, which is not happening right now. All right, now let's look at one more company, NetEase. NetEase is a little bit better company here. That's why it's in the good list. NetEase, as you can see here, it's a gaming company. They got online gaming. Earnings per share, as you can see here, it's a nice uptrend, which is good. Sales is also in a nice uptrend, which is good here. And shares outstanding is pretty constant. This company is not diluting the share count. And look, in contrary to what Alibaba has done, this company is trying to improve its operating margin. That's good here. From a negative, it's trying to turn into positive. Same story with net margin. It's trying to turn into positive here. That's why it's a little bit better bet here. And look, stock also is responding slightly here on the balance volume is going higher slightly. That tells you folks are buying into NetEase here, and stock is somewhat in an upper trajectory here. It's not a very bad story here. It's one of the stocks which you can invest in at this time here. And look, NetEase also provides an update on their status under Holding Foreign Companies Accountable Act here. That tells you companies taking some action to make sure the accounting is a little more transparent. That's a good story here. All right, now if you look at the earnings history of NetEase here, look, from an earnings perspective, contrary to what Alibaba has done in the last 2 quarters, earnings, they did an earning beat, which is good here. And look, September they had a negative, they had a miss on the earnings per share or EPS, but they did beat on the revenue here, which is good. And nice clip. Look at the clip here. The revenue growth is pretty solid here, unlike Alibaba. That's also good here. So with that, NetEase is a better one to buy, and you could slowly invest as it has come down so much. All right, so with that, when you're buying Chinese stock, be very selective. Buy the stocks with positive sales growth and positive net margin and low debt and positive cash flow. I will also add, look at the ones with a nice solvency. These stocks will not go bankrupt. And from a buy perspective, in the buy list, we got stocks like NetEase, YUMC, Dakio, and Qfin. And on the avoid list, we got here DIDI, TUYA, ZLAB, KXIN, and Seed, and many more. So with that, thank you very much. Happy investing and trading. Please subscribe.